Hey, welcome back to The Dive. Finnish and Swedish officials have declared their intention to join NATO, citing Russia's invasion of Ukraine. And our guest today will share his insights on the impact of this on the market, as well as inflation, recession talks, global food prices, oil, gold, the company's stop-loss feature, and why ETPs are a game changer. He's the founder and CEO of GraniteShares. Will Rhind is joining us today. But before we bring you Will's interview, do me one quick favor and just go ahead and smash that subscribe button so we can keep making you these videos. Hey Will, welcome back to the show.
Thank you so much for having me. Good to be back.
Yeah, it's so great to have you back. Okay, so let's start off with inflation. Inflation remains near 40-year highs despite the hawkish Fed. Do you think that the central bank can decrease inflation without causing a recession?
Well, this is probably the most important question at the moment, and it's an incredibly fine balancing act that the Fed has to do right now, because if they tighten too quickly, it almost certainly would push the economy into a recession. But if they don't do anything at all, then they can let the inflationary forces go unchecked. That could also be, devastating as well. So it's a real balance. I think so far what we've seen is financial conditions have been tightened, and I'm not necessarily talking about just the interest rate rises, because they have been really quite small in the grand scheme of things, but just the various Fed officials going out talking up the probability of rate rises, I think at the moment has done a lot to tighten financial conditions. And I think if that keeps up, we're already seeing a big adjustment in terms of asset prices, both in terms of stocks and bonds. That may be enough to stave off recession. But clearly that is the big question on everybody's mind at the moment.
Now, there is news that Sweden and Finland will submit their applications to join NATO, but Putin warns the West over NATO enlargement. If geopolitical tensions prolong, what impact do you think that this would have on the commodities market?
Well, I think that there's probably not any kind of immediate impact from those two countries joining NATO. That's more, like you said, more about the geopolitical environment, more about isolation of Russia as a country. I think that at the moment, what we've effectively seen is the canceling of Russia, on the global stage. And time will tell whether that will be eased in terms of sanctions, or whether the mood will change around that. But I think at the moment, what that means for the commodity market is just continued, not just uncertainty, but continued lack of supply from Russia, frankly, in not just oil, but in any commodity really that's produced, obviously out with existing contracts that were already in place before. So I think it just really will continue this current situation that we have, which is elevated commodity prices, until there's a workaround, or other sources of supply have time to come online.
Now, India, the world's second largest producer of wheat, has now banned all exports with immediate effect after a heat wave. What impact do you think that this has on global food prices?
Well, I think that in the short term, not really much, because at the moment it seems like the existing contracted wheat that was going to be exported anyway will still be allowed to be exported. It's more, I think, every country is trying to conserve or trying to secure food supplies. And, I think particularly in this case, it's clearly something that, in the short term, I don't think will have much impact. It's something that, again, because it's government policy, could be adjusted at some point in the future. But, clearly, whenever you're talking about banning exports and, government intervention in a free market, I think the perhaps unintended consequences is that it can encourage, things like hoarding, from domestic producers and players, which may exacerbate the situation even further. In other words, cause local or domestic food prices to rise higher because of it.
Now, in March, the United States announced a formal ban on Russian energy imports, which was followed by other countries doing the same. It seems that Russian oil is slowly and steadily being removed from global markets. Do you think that this is even possible? What's your read on the price of oil?
Yeah, I mean, I think as we mentioned briefly before, that that's exactly what's happening. I think it really the traditional buyers, in other words, Europe being the main probably case here, because the United States was much less reliant on certainly from oil from Russia. Remains to be seen whether they will find, this is Russia, will find another market for their oil and other commodity exports. But at the moment, this is what is causing a lot of this volatility in the oil market. And I think, really moving back to oil, yes, we have elevated oil prices and there is more supply starting to come online. But the big problem that we have in the United States with oil at the moment is lack of refining capacity. And that's really at the core of higher prices that we're seeing in gasoline terms and other energy products. And that really is the major bottleneck. It's not necessarily lack of supply, that is an issue, but it's more about lack of refining capacity.
Okay, so let's move on to gold here. The gold market remains under pressure and is holding above $1,800 an ounce. If gold doesn't start to pick up soon, do you think that it could ruin the entire thesis of owning gold?
I don't think so. And the reason for that is that gold has been around for a long, long time. And I think particularly in a situation like this, most people that have been around long enough to remember what happened in the 70s know that gold was the best performing asset class of that decade, which was the last real period of high inflation that we had, particularly obviously here in the United States. So I think that when people look at an inflation hedge and try and think about how to preserve purchasing power of their money, that is something that gold is known for. And I think gold will maintain that status. There are certain arguments or certain people put money into cryptocurrencies, of course, expecting or thinking that those might have some of the similar, I guess, attributes of gold. But at the moment, those have been completely unfounded. And I think that will cause people to think again about certainly putting money into more speculative elements of the market as opposed to rely on something like gold. Gold's having a bit of a challenging time at the moment because the real interest rates are rising on the back of the tightening of financial conditions that we've seen. Incredibly strong US dollar. And so it's natural for gold to pull back a little bit. I still think that in an environment where we have very high inflation, we have huge amount of geopolitical uncertainty and volatility in the stock market, what other alternatives do people really credibly have other than stocks and bonds in order to try and hedge against this environment? And gold, I think, is one of the standout asset classes in that mix and will continue to be so.
Now, we saw in one of your most recent interviews that single stock ETPs will be a game changer in your eyes. Could you give us some color on this?
Yeah, sure. So this is a range of products that we have in Europe or major European markets that provide leveraged exposure, long and short, to major companies, both US companies, UK companies, or European companies, and allow people to trade, like I said, both long and short, leveraged exposure in the same way you would any normal ETF. But we're talking about companies like Tesla, companies like Microsoft, et cetera, on the market. So really a new tool for active investors in the European market.
Now, GraniteShares has an intraday stop loss feature designed to kick in when the underlying stock index falls more than 50% in a day. Could you walk us through what metrics you used and how can investors leverage this?
Yeah, so the reason for this is really it's a safety feature of the product, whereby anytime you use leverage, it's more risky than not using leverage because the returns are amplified. And so if you have a move, you're 3 times leveraged, for example, and you have a move against you of 33.3% in the underlying, then 3 times 33.3% would be 100%. So you'd lose all of your money. So in order to stop that from happening, we have this mechanism called an intraday stop loss. It's a simple stop loss, but it's designed to be triggered at a 50% fall in the underlying index. And what then happens is the index rebalances. There's a 10-minute observation period before the index resets, and then the product can begin trading. But it's really just for those circumstances where you have extreme volatility, the price is moving, and it's moving down, or in a particular direction that if we didn't have a stop loss, may end up in a complete loss for the product, which we obviously want to try and avoid as much as possible. So it's a safety feature built into the product that helps mitigate risk in extreme volatile environments.
Okay, well, it sounds great. Thank you so much for joining us again today, Will. It's always nice to hear your insights.
Thank you so much for having me. Appreciate it.
Thanks so much for watching today. We'll be back again tomorrow with the latest news and updates, so you're not going to want to miss out. So be sure to hit that notification bell and subscribe below before you leave.